Well, let's take a deeper look into what's been happening with today's market action with our guest, Matt Stucky, Northwestern Mutual's Wealth Management Senior Portfolio Strategist. So, Matt, as we digest what the markets are looking at, we know that they're bracing for the Fed's moves, whether it's the interest rate hikes or the tightening. Why are we still seeing this volatility right now?
Thanks for having me. Happy afternoon. What I would say is that the wall of worry has been building as it relates to Fed worries. And, as we think back to where we started this year, just a little over 3 months ago, the futures market was pricing in just 3 or 4 interest rate hikes for all of 2022. We're quite a bit above that now, and markets are pricing in a federal funds policy rate at about 2.7% by year end. So that's a significant amount of ratcheting up of Fed tightening that's been building up throughout the year. And it's one of the major reasons why we've seen volatility kick up as well.
If that's already the expectation, then why have we continued to see a sell-off to this magnitude?
Well, I think part of it has to do with sentiment. Typically when we see big drawdowns in equities, sentiment is usually one of the main reasons why you see that volatility. And just this past Thursday, we saw the AAII bullish sentiment survey dip below 20% for the third consecutive week. That's near the lower end of what we've ever seen for that index over the last 30 plus years. And so sentiment is quite bearish right now in the markets. And to your earlier point about how these fears have been building in terms of the Federal Reserve, what you've seen in the past and using that as a historical analog for kind of where policy ultimately settles out versus what's expected, we think that we actually might be near the peak of Fed worries as it relates to markets here.
We haven't had a 50-point hike since 2000. You're projecting 4 straight. Is that too much too fast?
I don't know if we're necessarily projecting 4 straight hikes, but the market is pricing those in. And that actually might serve as a source of upside throughout this year. If, for example, we get a couple of 50 basis point hikes in both May and June from the Federal Reserve and inflation starts to roll over, we actually think that we might not get as many hikes as what's built into the futures market right now. It's just expecting about 10 interest rate hikes throughout the year. Using the 2-year yield as an example, usually you don't see federal funds rates exceed kind of where the 2-year yield tops out. And that topped out so far earlier this month at about 2.68%. And policy rates for in the futures market is sitting at 2.7% by year end. And it's one of those things you look at and say, are we at the point of peak fears and as it relates to Fed policy here?
So then as we wait for May the 4th to get some more clarity on all of this, how are you advising clients to manage this period?
It's one of those conversations you have with clients, and you remind clients, especially those that have equities in their portfolio, that volatility is a feature of markets. It's not a bug. You look at the last 42 years in markets, on average, there's an intra-year decline of about 14% in any given year. But if you look at all 42 years, 32 out of those 42 years were positive total returns. And so volatility is a feature of equity markets, not a bug. And so understanding kind of their equity position relative to other diversified assets is a way to kind of keep the broader perspective in mind as we talk about clients and their portfolios.
Is there anything that we could see this earnings season that would quell some of the concerns that investors have right now?
A lot of investors are paying really close attention to 2 things on earnings calls. One being the forward outlook, 2 being margins. And so any kind of reassurance that individual companies can talk about with their investors about their outlook for the remainder of 2022 and into 2023 in terms of the health of their business as well as their margin structure, reassurances are being met with positive reactions the following day in terms of price reactions.
Clients wondering where they can wait out the rain. What are you telling them?
We actually think right now a lot of the pain is already in the rearview mirror in the bond market. While it's been a painful first quarter for high quality bond investors, there was a whole lot of expectations built into the futures market as it relates to fixed income. And so, bond investors typically are not used to seeing this type of volatility in high quality fixed income. But here you're actually able to find pretty decent credits at 4 to 5% total returns. So, that's an area that we can look to, if clients are really concerned about the volatility, that, maybe we should beef up those allocations in their portfolio.
I want to talk about consumers because they do still seem willing to spend despite what we're seeing with inflation. How long do you expect that to last, though? And when do you expect that to start eating into some of these earnings that we might see?
Well, one of the reasons why, we still are fairly optimistic about the economy from here is that consumers are in a pretty good position, even with this tick up of inflation the last year and a half. Actually, for the first time in 30 years, households in aggregate have more cash sitting on their balance sheet than they have debt. You usually don't see those types of trends going into an economic slowdown. In fact, that just builds further resiliency with the U.S. consumer. And I would also add that, behind some of the slowdown that's been happening as some of the fiscal stimulus effects have worn off to start this year, there's still a pretty healthy job market for consumers that is propelling consumption growth. If you look at just a proxy for national income growth, which we loosely define as the amount of people that are working, what they're being paid for their work, as well as how many hours a week that they're working, and a year-on-year trend of that's up about 9.5% year over year. So, that's a healthy amount of growth that can continue to provide a lot of resiliency for further consumption growth from here.
A bit of a circular ending here, I suppose, because that is the labor environment, something that the Fed is going to be paying close attention to. Do you expect labor force participation to continue to tick up, given some of the very metrics that you mentioned a moment ago?
I think we are expecting that to happen, and you saw about 3 million people come back into the labor force in the first quarter. A few reasons behind that move is, first and foremost, wages are higher. That entices more people to come back to the workforce. You've had a lot of stimulus dry up, and so there's almost a necessary move here for people to get back to work. The pandemic's also started to get more reasonable in terms of its effect on people, and so people are not being forced to stay home because their kids can't go to school or their daycare is closed, and so all of these factors are helping bring workers back into the job market, and hopefully will help to kind of keep this cycle going into the future.
So, all right, Northwestern Mutual's Matt Stucky, appreciate your time, sir. Thank you.